Changing tack and looking to the stock markets of the world and how we see the picture in terms of what our starting point is, there are a few big picture things that, if I'm honest, scare me a little, and the chart on the left there is probably one of the main ones. And why does it scare me? Well, on top of the US being 70 cents in the dollar of your global equity exposure these days, which is a massive number, the Magnificent Seven and tech are about 30 to 40% of that 70%, and those seven stocks are more than the UK, China, France and Japan combined. The weights of these companies are just extraordinary, and the amount of money that investors have in that tech theme, which is obviously pervasive and persuasive at the moment, is pretty alarming. The map of the market on the bottom right there just hits me in the face when I look at Nvidia and compare it to the basic materials sector. That one stock is more than the entire basic materials sector in market capitalisation. Nvidia went up 7% in a day last week. Just that daily move is about the value of BHP, or about 10% of the Australian stock market. They're absolutely astonishing numbers, and they're great companies. They're doing a great job and they're making astonishing amounts of money, but growing profits in those sort of companies, and they are at pretty high multiples, is extremely challenging from that base. The law of large numbers has to kick in at some stage, and you need to be aware that you're needing to start to annex small countries to get a year's profit growth. These are massive numbers. In digging down a little bit on the valuations underlying that, this is sort of a picture of, on the left, the valuations of markets around the world, and on the right, the valuation of sectors in the Australian market. And I'd probably point to a couple of things. Number one, the NASDAQ in the US markets, they are starting at very high multiples versus history. 30 times earnings is a big number. And 9 times out of 10, when you bought stocks at that price, you do not make money. People lose sight of it, but starting points and starting valuations matter. And they always have, and people have forgot that because a lot of the last decade's infectious, and most people who haven't had a long period of experience, what do the 25-year-olds of today think? You'd be crazy to think that you should buy anything other than a tech company. They always outperform and stock markets always go up. That's the sort of behaviour that influences that, and that's how you get to those sorts of valuations. At the other end, you've got markets like Europe where they're at very pedestrian multiples as over-regulation and a lack of growth really permeate the psyche there. But you have seen, you're reaching what seem to me to be pretty extreme points in terms of how much of the world's capital's in the US and how little is everywhere else. And it doesn't look like a balanced picture. In Australia, I'd probably make the same comments that the tech themes, scarcity, if I hear another person tell me about AI, data centres, etc., all of those themes, chasing momentum's been very pervasive. The multiples there, and again, I'll pick a stock, but something like a WiseTech Global, again, great company like the Magnificent Seven, but we are paying today about $33 billion for WiseTech Global. When I look at those maths, it's like at some stage the company's got to mature, and for me to call it a 9 or 10% return on my money forever, I need that company to make about $3 billion in operating profit. If that lasts in perpetuity and I've paid $33 billion for it, I'm going to get about a 9% return on my money. The problem with that $3 billion is currently the company makes about $1 billion in revenue and about a few $100 million in operating profit. So today's price, in my rough math, says let's assume that it makes exceptionally high margins, 50%, which is more than the Magnificent Seven make for the most part. And you think $6 billion of revenue at 50% margin would give you 3%, would give you $3 billion in operating profit, but that means a 6-fold increase in revenue and a 10-fold increase in profit to get there. And if all that happens, and let's say that takes 15 years, The difficulty is I've paid $33 billion for it today. If I get there, and that will be an astonishing effort, an extremely well-run company, I won't make any money because I paid that price for it today. People don't look at stocks like that way. They value them on revenue multiples, but real life, they are the maths of investment, and you have to care about the price you pay, and that's the reason why we are just looking elsewhere when it comes to valuations, because those numbers, they might be good companies, but buying a good company at a stupid price doesn't make it a good investment.